What's up, guys? I can't tell you how often I see people asking online, is this the bear market? Or is it too late to start investing in X poop coin or this Y token? And across the board, almost every time they would get an answer of, yeah, it's likely the bear market, from their favorite influencer, they would respond like they missed out. What I've come to realize is that a lot of people don't understand this one simple truth that I'm going to show you today about crypto markets. What I aim to demonstrate is, if you understand how to properly vet projects and you're willing to take the time to make money slow, the bear market is the best time to position yourself to make the most money. Let's be clear about a few things. When I say vet a project, I don't mean hearing about it from a couple big influencers on Twitter who say whatever coin is primed to do a 20x. What I'm referring to is doing research into the current and expected utility of a project and finding out how that value accrues to the token, if it does at all. And when it comes to a bear market, that isn't when a coin you happen to be holding is having a correction over a couple weeks or even a month. A bear market is a sustained period of stagnant or declining price action. This has to happen over multiple months at a minimum. So, what do I mean when I say that the best time to position yourself to make the most money is during the bear market? Well, I guess the best way to explain it is to show you. Let's take three popular assets, Avalanche's AVAX, Ethereum, and Terra's Luna coin, and compare dollar cost averaging over a 6-month period of time during the previous bear and bull market cycles. For this example, we're going to start with $1,200 and invest $400 on the 21st of every month over the period selected, and then cash out at around 20% pullback from the market peak. For those of you who might be curious why I dollar cost average, it's pretty simple. Over the long run, I do better dollar cost averaging than I would trying to time the market with perfect buys or sells. So let's take a look at Avalanche during the bear market first. On May 21st, it closed at $21.79, and we were able to pick up a little over 18 AVAX. On June 21st, it closed at $11.34, and as you can see here, we were able to pick up a little over 35 AVAX that day. July 21st closed at $10.49, and that day we were able to pick up over 38 additional AVAX. The average price we paid during that period was $14.54 per AVAX, and we were able to get a grand total of almost 92 coins. Ethereum on May 21st closed at $24.30, and we were able to pick up a little over 0.16. On June 21st, ETH closed at $18.84, which is a great low buy if I'm being honest, and we were able to pick up over 0.21. The 21st of July's close was $19.95, and we picked up an additional 0.2 ETH. The average price we paid during this period was $21.03, and we were able to get almost 0.58 ETH. Luna on May 21st was all the way down to $8.22, so the 400 was able to get us almost 49 Luna. The 21st of June closed at $4.86, which is a great low buy in hindsight. That day, we were able to pick up an additional 82.3 Luna. On July 21st, Luna closed at $6.61, and we were able to pick up an additional 60 Luna. On average, we paid $6.56 per Luna, and we were able to get 191 coins. Now, let's take a look at examples from the bull market over the next 3 months and compare how we did during the bear market. Again, we will start with Avalanche. On August 21st, AVAX closed at $43.71, and we were able to pick up 9 coins. On September 21st, AVAX closed at $59.15, and we picked up almost 7 coins. And on October 21st, we were able to pick up an additional 6.5 AVAX at the close price of $61.49 per coin. The average paid per AVAX was $54.78, and we were able to get 22.4 coins. When you compare that to the bear market, we paid about $40 more per coin and acquired 69 less coins, which means that when we eventually liquidated this $1,200 position at $117.30 per coin after building it during the bear market, it was worth $10,764 versus liquidating the position built in the bull market, which was only worth $2,629. For Ethereum, the difference was less pronounced since its price is less volatile. The first buy on the 21st was at $3,232.37 for 0.12 ETH. The next buy was for $2,767 for 0.14 ETH, and the last one was for $3,529 for 0.11 ETH. The average price paid was $3,176, and we were able to pick up a little over 0.38 ETH. Compared to the bear market, we paid about $1,073 more per ETH, and acquired 0.2 less ETH. Liquidating that position built during the bear market at $3,881 was worth over $2,240 versus the bull market position being worth $1,281. By now, I think you're starting to notice a pattern, so we will take a quick look at Luna. We made the buys at 27.53, 25.17, and 40.98. Each buy got up to 14.5, 15.9, and 9.8 Luna respectively. We had an average price of 31.22 per Luna and were able to get about 40 coins. When we compare to the bear market, we paid $25 more per coin and received about 151 less coins, which means that when we liquidated our position after the 20% pullback at 82.79, our position that we built during the bear market was worth $15,852 versus only $3,326 for the bull market position. Now you might be saying to yourself, well, of course, who wouldn't want to buy low and sell high? That's the dream, right? And you'd be correct. However, it's very hard to do that reliably if you don't know how to properly vet potential projects you want to invest in so that you can build conviction. How you do this is an entirely personal decision. I'm not a financial advisor, so I wouldn't ever tell you what to do with or how you should invest your money. All I can do is tell you what I use to help guide my decision-making process. So to make this simple, I'll tell you the two most important things I look at to decide if a project might be worth investing in. The first is utility. Utility in this context simply means what is the token used for? In my opinion, this is primarily a way of disqualifying poop coins. For instance, if the primary utility of a coin is governance or gives access to an activity that I don't find useful, then that token, in my opinion, has utility I don't typically value. So I would probably pass on investing. On the other hand, if there's a token that does have a utility that I personally find valuable, then I move on to understanding the tokenomics. Tokenomics are the economics of the token. This usually includes finding out the maximum token supply, the initial distribution, the inflation rate over what period of time, and how that inflation will be used. Let's say, for example, my favorite influencer says Safe Poop Coin is going to the moon because they just partnered with Blockbuster to allow you to rent movies using the token. Even if, for some reason, that didn't set off red flags in my head, if I go to their documentation and it shows me that there is an infinite supply of this token, that tells me I need to pass because my personal investment thesis is that inflationary tokens make for poor investments in general. However, let's say that I hear about a token that allows me access to something I value and couldn't get without using the coin. Not only that, but every time I use the coin to get access to this hypothetical thing that I value, the token is burned, meaning it will no longer be circulating. And there's a fixed supply. This is a token that I would spend more time looking into because it passes my first two criteria of having decent utility and good tokenomics. An example of a token with good tokenomics, in my opinion, would be Luna. Luna has a fixed supply and uses non-inflationary rewards when incentivizing validators to validate transactions on the network. If you want to know more about why I believe non-inflationary tokens make better investments, check out this video. That's it for this one, guys. I will see you in the next video, and as always, we can keep talking about getting more coins.